Hello everyone, welcome back. Happy Sunday. Hope you guys are doing well. Checking the live chat right now. If you guys can let me know that you guys can hear me all right and that you guys can see the DXY monthly chart. Eslam, thank you, sir. Jesm, thank you. Tyler, Olawale, thank you guys. All right, much appreciated. All right, everyone. Hope you guys are doing well. Hope you guys had a relaxing weekend. Hope you guys stayed safe last week. As you guys know, I told you guys to fasten your seatbelt because they will be repricing these markets aggressively. So with that, going into this week, I'm still expecting much more volatility, which again, for us as traders means opportunity. So with that, we'll go into, again, the pre-market routine, what it is I'm looking at, what factors am I weighing out through intermarket analysis, and what my targets are. As you guys know, I tend to have the winning lottery numbers once in a while. So let's go ahead and unpack that this week, and we'll sort out the price action and what we have moving forward. Again, hope you guys had an excellent weekend. Kersey, hello. Jesm, hello. We are ready. Absolutely. Musa, back to business. Yes, sir. Unicorn Queen, hello, hello. Tyler, hello. Hope you're doing good, brother. Denisha, hope everyone's ready for the trading week. Absolutely. Momentum Trader, Tyler, hit that like button. Absolutely. Much appreciated. Please do. Hello, Wale. Happy Sunday. Hope you're doing good, brother. All right, guys. We're going to get right into this one now. Richard Watts, hello from Texas. Big shout out to Texas. All right, guys. Monthly chart. We'll go and get right into this one. As you guys know, we'll go through currency, bonds, and then we'll get into stock indices. And then after, I did schedule a bit of time to take your questions. I'm not sure if I'm gonna be here for the full hour. I have quite a few things on my schedule, and I also got to get to the weight room before they get closed. So I got some things that I gotta take care of today, but I will schedule some time to take a few of you guys' questions before I get going. All right, so going right into it, monthly chart for dollar. We're looking for higher prices. As you guys know, we were looking at this balanced price range before, and we managed to trade above that. So moving forward, I took your guys' attention to this swing high here, and that has been the anticipated expansion for this month. So if you guys will look here, there's a countdown till the bar close. So because there's still 9 days left of the month, I'm still expecting continued expansion higher. We still have targets on the upside, so I'm still expecting expansion profile on the upside based off what I'm seeing on the monthly chart. All right, so on the weekly chart, if you guys will recall, we were looking at this underlying market structure, right? Telling you guys it was bullish because of how we have the highs, or how we have the lows, stacking up, and how we're taking out key intermediate term highs, right? So I also took our attention to this weekly inefficiency. We traded down into that. We were expecting that to be support with this down close candle. And then again, it was even better that it left this inefficiency open, as I highlighted to you guys, because now we can qualify that as a breakaway gap, which is a signature indicating the market's extremely bullish. And then we get that delivery on the week before last. And then this previous week, we opened, traded higher, and pulled back into the range. And for the most part, just a consolidation week. Again, which is reasonable after we saw such a large range expansion the previous week. So moving forward, we have a weekly inefficiency here below market price. The draw for me still remains these equal highs. Until something substantial occurs on that daily chart to the downside, in my opinion, there's nothing bearish on dollar for right now, and I'll be looking at the highs. And then if you even factor in seasonal tendencies as well for dollar and indices, I don't have my seasonal tendency charts up, but just gonna let you guys know what factors I'm weighing out. So seasonal tendencies are suggesting also lower prices for indices as well. Alone, that's not enough, but in addition to market structure, order flow, knowing what you're looking for in that regard, then seasonal tendencies are absolutely useful tools. So again, weekly fair value gap here. This is going to be an influential level moving forward. Again, if we're going to remain bullish, we should stay above this inefficiency here. We can open and trade down into it in the coming week, but again, I'd even prefer to see it stay in the upper portion and then trade higher and again expand into these highs there. On the flip side though, what would invalidate my bias would be closing down below this weekly fair value gap. So again, give you guys the other side of the coin. So if we close down through the fair value gap and then we trade through this down close candle here, then I would no longer be bullish dollar. All right, so daily chart, we have a higher time frame market maker buy model. So looking at this inefficiency that was created on Friday's trading and Monday's candle, we traded down into this daily inefficiency, found support, and now the market's trading higher. I also indicated to you guys last week that I preferred to see this inefficiency here left open. Reason being, because again, if we can classify that as a breakaway gap, that would suggest that this market is extremely bullish. So looking at that, prefer to see that left open. If we trade down into it, it wouldn't change anything fundamentally. It still can trade down into this inefficiency. Again, I would just prefer to not see it do that based off what I'm seeing in the monthly range, which is open, low, high, close, and I'm still expecting expansion based off the monthly candle. So again, I do top-down analysis, and everything I do as I'm refining through the time frames is always going to be linked to those higher time frames. And then private group, we have much more on that going into this coming week. So again, daily inefficiency here, also overlapping with this former mitigation block over here. So again, that's one of the other reasons why I also prefer to see us stay above this inefficiency and again, expand higher for the buy stops that would be here. Last week, I gave you guys this inefficiency here as an upside target. Monday into Tuesday, we traded into that. And then once we reached targets, market went into consolidation and then we had a shallow retracement into the daily inefficiency. But again, everything's still a green light for higher prices based off what I'm seeing. Obviously, the market structure is bullish and the order flow continues to remain bullish as well. So again, as long as we remain above this daily inefficiency here, I will be looking for continued higher prices on dollar. And then as always, we also make our newsletter available to you guys, which is what we're looking at in terms of the economic calendar, earnings reports, and how we're going to attack the week based off those factors. My associate also does include the COT reports based off dollar, and it's been absolutely money. So if you want to get signed up for that, that's there should be a link in the description for our website, but you can drop that. If you scroll to the bottom, you can give us your email, and then you will have those insightful newsletters sent to your inbox. So if you guys want those insights, that's where you can find them. But again, an additional confirmation to everything I'm sharing here on the technicals is fundamental factors behind it, which I touched on a little bit last week with regard to the war and what's going on there and why money flows into dollars like a safe haven. It's like a safety trade, as you'd call it, but also other fundamental factors with COTs indicating the market's also poised for higher prices. And then when you get all those factors in alignment with market structure, right, with institutional order flow, then everything starts to become clear for you. So again, moving forward, going to be looking for these highs here on the daily chart. Let's go right down to the hourly. All right, so on the hourly chart right now, we're trading within a range, and I would define that dealing range from this low to this high. We traded down last week into a short-term discount, and then we expected the turning point once we traded below equilibrium, below the stops, and into this daily inefficiency, right? Because we're bullish, so a discount is a means of buying, right? So from the discount, we expand higher, but then we remain in the range. So what I'm looking at for this coming week, again, we have this daily inefficiency below us, but we have relative equal lows and equal highs. So if we're bullish, I'll be looking for some potential accumulation, which is what we have here, manipulation low a week inside this daily inefficiency, and then again, reprice up into the premium targets. So based off what I'm looking at in the current structure, I will be looking for some weekly profile to manifest this type of market structure. Some things to keep in mind though, because of the state of the world right now and what's going on, these markets are extremely erratic and volatile, and things can change at the open as well. So if there is some significant gap higher or lower in these markets, that can also adjust that analysis as well. So I'd say that to say just be ready to adapt. Again, because of the recent geopolitical events and things going on around the world, that absolutely has an impact on the markets, as you guys can see in the recent price delivery that we've been getting. Right, so it is important to be mindful of all those factors as well. And when there is higher levels of manipulation, we also have to be mindful of that as well. So moving forward, in summary, expecting us to find support inside this dealing range. There's no need to break it to the downside. We can trade below these lows. If we trade below the lows, I'd want to see us reject it sharply. If we do something outside of that, then I'll just have to weigh that out at the time and then see where to pivot from there. All right, moving right along, Treasury bonds. So we are looking for lower prices on the bond market, top down. So this market has been weak for some time. And then again, we had the dealing range from high to low. We traded into a short-term premium. And then again, I told you guys the market was likely to rotate lower as a result. So one of the downside objectives that I gave you all last week was this down close candle here on the monthly chart, which is a bullish order block. And then we nailed that perfectly going into last week. So if we're going to remain bullish on bonds, I'd want to see us displace down through this down close candle and then reach for the sell side here below market price. All right, weekly chart, again, expansion lower, reaching into this inefficiency here on the weekly chart. So we also have a weekly fair value gap above us. So it would be permissible for the market to trade higher into that fair value gap and sell off. This fair value gap here, I qualified this to you guys when we were back up here, that this would be an inversion fair value gap, meaning I'm not expecting it to trade down into it, use it as support and trade higher. We're likely going to get below it, use it as resistance, and keep selling off. So I haven't abandoned that idea. I'm still bearish on this market, which would suggest that I'm going to expect premium arrays or key levels above market price to keep the market at bay, or in other words, resistance. So as long as we remain below these key levels, I will continue to look for lower prices on bonds moving forward. And then again, we have this inefficiency here as a downside target. How we trade there will be influential. And then if we continue to accelerate down through that level, we have sell side down here. All right, daily chart. So we were in this range. We trade up into a short-term premium. We were expecting it to break down. We were watching this fair value gap and mitigation block here. Market turned on a dime. Got down below it, traded into this fair value gap here. Again, just continuing the bearish order flow. So again, nothing's changed in terms of my perspective on this market. I will still continue to look for lower prices. We have these smooth lows down here that I'd look for as a draw on liquidity going into this week. Again, as long as the order flow remains bearish, which is what I just highlighted to you. So as long as, again, we remain below this up close candle here, we're still looking for lower prices on the bond market, right? And where this is useful is understanding how currencies relate to bonds. So with bonds selling off, that's going to be bullish for the US dollar. All right, so weekly chart, look at some higher time frame perspective. For yields, I've been pointing higher, looking for higher prices. And again, this is one of the reasons why I've been confidently looking for higher prices in dollar, right? So it's not, again, just what I share on dollar. It's how all these factors that come together, how this gives us elite level precision, right? So looking at these higher prices on dollar, that's going to be on the back of higher prices in bonds, or in the yields, excuse me. So looking at the yields here, we've been expanding higher for the past 3 consecutive weeks, again, as our analysis has been calling for. More specifically, I took your attention to this weekly inefficiency here above market price, and we traded into that last week. Except on the 30-year yield, it did fall short, but the 5-year and 10-year reprice into their respective inefficiency, right? So moving forward, still bullish on this market. There's nothing that would suggest this market's bearish. I'll continue to look for higher prices into the buy side here. That would be above the external high of the range that we're trading in. So again, still looking for higher yields, which is again going to support all the analysis that I share in dollar on the technical side, the analysis that my colleague makes available to you guys on the fundamental side with the COT reports, and it's a matter again of how those factors come together. Oh, and also the seasonal tendencies. So again, all those aren't necessary, but if you want precision, that's what precision requires, weighing out several factors. So again, after, I think it was Thursday night going into Friday's trading, a lot of manipulation in the market. Yes, Friday was a large range day, but it was a highly manipulated day. I noticed towards the AM session, going into the PM session, the market started to stabilize and start to perform in a way that I would want to see it perform. If the market's erratically spiking up and down, I don't prefer to trade those market conditions. There needs to be a rhyme or a reason to what it is I'm doing or why I would incur risk. It's not just seeing a bunch of crazy price swings. And we're in that environment right now, right? For black swan events, for things to happen, and the markets can absolutely get violent in their repricing, right? So whenever I see that from a risk management standpoint, if I'm not able to frame the risk in a market condition, I'm not able to take a trade, right? And if you go into like your 1 minute chart and you look at, or a 5 minute chart, and you look at Thursday evening and look at the trading going into the London session Friday night, a lot of volatility, right? A lot of manipulation. If you're seasoned, if you're experienced, you can absolutely get on that bull and ride it around. I'm not saying you can't, but someone that's developing, those are market conditions that when each 1 minute candle is 40, 50, 60 points in its size, those types of market conditions can absolutely dismantle you if you don't know what you're doing. So I just want to emphasize that caution, especially to my community here with, what it is that we're doing. We're not looking to take wild gambles or wild stabs at erratic price swings, right? What we're looking for has to make sense. There has to be a logic and a framework around it. And the main point and the main takeaway from what I'm saying is risk management cannot be underscored in these market conditions that we're in now. So daily chart here, looking at the averages, we finally got Nasdaq leaving its range, as I highlighted to you guys last week. Dow was already selling off. Dow again was relatively clean. We had the breaker here, fair value gap traded into that. Took your attention to these lows here, here, and here, and we delivered that for Dow. And then again, I used like the six sister concept, since Dow had already repriced to these relative equal lows here, and Nasdaq had yet to leave the range. Nasdaq was again likely to give the more dynamic run to the downside to price in market symmetry. If you'll recall what I shared last week, since these indices are symmetrical, which means they move in tandem, they're going to look to price in market symmetry, right? If that market symmetry isn't there, that gives us a lot of insight as smart money traders, right? That's where SMT comes in. That's where Six Sister comes in. And if you understand narrative, framework, top-down analysis, using tools like Six Sister, SMT is extremely helpful, right? So that's how I was able to time the breakout on Nasdaq, where I'm not a breakout trader. That's why I do that. Quotations, not making fun of any breakout traders, but I don't trade that way. But when I'm referring to the breakout, I'm referring to us leaving this consolidation and entering expansion. The way I was able to time that was seeing with what we had in the Dow, right? So I was going to look for Nasdaq to look to catch up, because again, it's logical that markets that move in tandem are going to want to price in market symmetry, right? So you can use that Kraken correlation to your advantage if you again have an understanding of narrative and where the market's going to go, right? And again, that's what I'm providing to you guys here on these Sunday streams. So again, that's the only thing I wanted to touch on with NQ. So again, weird day on Friday. Dow finished with an up close. So Dow had a bullish day, and the other averages were considerably bearish. And again, that's just a signature of lower probability, more difficult trading market conditions, right? Not saying it's impossible to trade, but decoupled markets moving extremely fast where it's difficult to manage risk. As a newer developing trader, those are all things that you definitely want to be mindful of, especially in these in this climate that we're in right now. All right, guys, moving right along, looking at stock indices. We'll start from the monthly chart. As you guys know, I took your attention to this monthly inefficiency here in purple. We traded down into that, and then we've closed down below it on the weekly chart. Right, so moving forward, I'm going to look for this monthly inefficiency here below market price, and then if we get acceleration down through that, then I'll look for this monthly inefficiency in trading into these 3 consecutive down close candles as a draw for the monthly candlestick. Are we going to deliver all that range in the next week or before this month closes? It depends. It absolutely can, especially with the volatility that we have now. But that's going to be my outlook for the next 2 to 3 weeks going into May. And again, there's also a seasonal aspect as to why indices are bearish. There's a saying on Wall Street usually goes, sell in May and go away. And again, it's just highlighting the seasonal tendency that typically April into May, indices tend to draft lower as a result. Again, that in and of itself isn't helpful, but if you are able to again map out a framework, right, and a narrative around what it should do, then again, those tools are extremely helpful in that regard. And again, I've been walking you guys through this each week, the SMT at the highs, why the markets were going to rotate lower, how we relate that to the dollar index, right? And then how all that comes together. So again, those are my targets on the downside for the monthly chart, just so you guys know my intermediate term and long-term perspective as well. All right, so weekly chart. Again, we created that swing high here on the weekly chart. So I told you guys whenever we create a swing high and we're bearish, candle 4, again, a swing high is a 3 candle pattern. So candle 1, 2, 3, with candle 2 being the highest high of the other two candles. All right, so whenever we get that swing high formation and the narrative is already suggesting we should be bearish, the fourth candle or candle number 4 in that swing high pattern is going to be extremely helpful. If you just look for that pattern in and of itself, like for example here, oh look, where there's the swing high here, and look, this candle didn't drop, right? There's narrative behind it. We were bullish here. We're looking for higher prices. We weren't trying to call a top. And as I told you guys, when the top is in, it's going to be in, and we were able to map that out handsomely. But again, it's not just about looking for that pattern, right? It's about the context that it's going to want to reach lower down into discount levels. So with that understanding, frame the swing high. So that frames a nice weekly bias for the week, and then we got a nice heavy week. One of the other confirmations that the week was also going to be heavy was how we opened, traded higher into the previous candle. So that's an immediate rebalance. And then we got energetic price delivery as a result. Another signature that was helpful in identifying the weakness in stock indices was how I was unable to even trade up to the midpoint of that wick. Right, so staying below midpoint of the wick, immediate rebalance, and then we accelerate lower, right? So whenever we do get immediate rebalance, we want to see that candle or the next one expand, because if it doesn't, it could be indicating that it's likely going to retrace or reverse or consolidate. So some things to keep in mind that I've learned through experience with these specific signatures, right? So delivering as we'd expect. Again, we're bearish. We're looking at lower targets here on the daily chart, and then we got that expansion on the weekly. Again, nice to see the markets moving. Really, February through March was relatively lackluster, small ranges, and just a slow grind higher. Whereas again, now we have ranges that are open, and you guys know what that means. We're open for business. All right, daily chart. Moving right along. So all these purple rectangles are here. I know it looks like it's a lot of levels, but it's really not. I'm just extending the inefficiencies, right, that you see on the buy side of the curve when we're bullish. These inefficiencies that lend support here, here, here. When the market's bearish, again, ever since we were up here, I was taking your attention to this fair value gap, qualifying it as inversion, right? We wanted to see the market stay below it, right? Monday, we trade higher. This old inefficiency, extend it through. Resistance, market trades lower. Inefficiency here that was support when the market's bullish is going to be resistance on the downside as we reprice into the targets I gave you guys last week, which were these equal lows here. And then below that, I gave you this inefficiency down close candle. And then through that, we had these equal lows as well. And again, a really animated week in the price delivery. 5 consecutive days of just absolutely smashing lower. And again, that's on the heels of everything that's going on around the world. And as I was explaining to you guys last week, the people that control the markets, that reprice these markets, they use those world events to inspire fear and greed in the marketplace. So again, that's why we got animated price delivery lower and then trading into the sell side liquidity. So one of the signatures, one of the things I was looking for last week was the market to trade into that daily fair value gap and sell off. So give like institutional order flow entry drill. That would have been ideal. But the fact that it wasn't even able to trade into it indicated that the market's exceedingly weak. So the fact that we were unable to trade into that, market continues selling off. So going into this week, I'm still looking for lower prices. Nothing's changed. We have sell side here. And then on the weekly chart, we have this weekly fair value gap and then weekly bullish order block. So those are my targets on the weekly. Refining that down to the daily chart, that weekly fair value gap, sell side liquidity. Through that sell side, we have this inefficiency here in down close candle. And then if we accelerate through all those levels, we have these relatively equal lows here. So we could see again another large range down week. And again, the economic calendar is also suggesting that we should see some action. But again, when you're trading in times like this, Friday, there was no economic reports that were due. but every day is a high impact report when you're on the brink of World War III and in the other part of the world. So while yes, the economic calendar is really helpful, we are in unconventional market conditions right now, again, with everything going on. So just some things to keep in mind. A lot of people were caught off guard by the large range we saw on Friday and why it was delivering like that. And again, that's just these conditions of what we're seeing geopolitically around the world. And again, market makers use that sentiment when they're repricing these markets. So that's all I'm going to say on that. So again, looking forward further downside, I'm not bullish. There's nothing bullish about these markets to me. I'm looking for lower prices. Logically, the market's not just going to go straight down forever. So when's it going to be time to consider a potential retracement? Once we reach targets and once we see a change in market structure on the lower time frames. That's how you know we're going to retrace. All right, 4-hour chart. Let me check my notes, make sure I hit everything I wanted to. Yeah. All right, so daily chart, last thing on the daily chart. Again, how did I come to the conclusion that I was going to want to deliver into these highs and lows? The last thing was the quarterly shift, which again, I was indicating to you guys that from the first day of the month, you cast back and it's going to give you the algorithmic reference points that the targets are, that the algorithm is going to want to use as targets, right? And the reason behind that is the way ICT explains it, which is really well in terms of understanding higher time frames. What's the market actually doing, right? Once you understand that, it removes the mystery. There's fund level traders with stops below these lows here and stops here and here. So the market's trading down into those fund level stops. So that's part of the narrative as to why we see quarterly shifts occurring, right? And why the market's going to run on the recently created liquidity in the marketplace, because it's seeking the highs and lows at the fund level, right? So that's why daily bias is really important. And I see a lot of things that says, you know, you don't need daily bias or trade with no daily bias. And if you know what you're doing and you're really good at reading intraday liquidity, you don't need a daily bias to be profitable. I'm not suggesting that you need it, but imagine what a disadvantage you would be at not knowing what we knew going into last week, that this thing is going to crater the entire week. So from Monday to Friday, we repriced 250 points in the downside direction, and each day was a down close. Why would you want to go long in that market condition? I'm not saying you can't go long or there's no, again, counter trend, short-term retracements that you can scalp, but why would you want to trade against that underlying order flow, right? It just makes for difficult trading. So understanding a daily bias is absolutely advantageous. And I think people that neglect daily bias, weekly bias, higher timeframes in your analysis, you're absolutely putting yourself at an extreme disadvantage, not knowing where those higher timeframes are going, right? Because if you didn't have the levels that I told you to put on your charts last week, you wouldn't know it's repricing into these lows here, or this inefficiency or these lows. And if all you're doing is, you know, looking at the market through a 15-minute chart, it's really easy to lose all your perspective on what the market should do, right? So I want to reemphasize that to you guys, because I know I give you guys a lot of information here on these Sundays, but I also want it to be actionable for you, right? So you can take this insight and do something with it, right? And again, that's what you would look to do with that information. So 4-hour chart, again, the institutional order flow and the market structure remains bearish. So mitigation block, we traded into that. I gave you guys that key level on yesterday's stream, not yesterday's, excuse me, last week's stream, saying that the high of the week would likely manifest in this key level because there's a range from high to low. That's our dealing range. We trade up into a short-term premium. We don't expect this intermediate term high to be taken out. Why? Because the market's bearish, right? So market trades higher, breaks down, inefficiency, trades into it, and then we just continue the bearish order flow all week, right? So nothing is remotely bullish about this market. So I'm, again, continuing looking for lower prices. On the 4-hour, my targets are the previous week's low here. If we get animated down through that, we have this sell side here on the 4-hour, the weekly inefficiency, and then this is the black line is the weekly bullish order block. And then down through the bullish order block, we have these equal lows on the downside if we really want to get animated on S&P's downside delivery. So that's the business for S&P. Yep. All right, NASDAQ, let's keep it moving. And then again, I'll take a few of you guys' questions, and then we'll already get going. All right, monthly chart. Took your attention last week into the monthly inefficiency. So that was one of the downside levels we were looking for. And again, because we're bearish, I don't suspect the market's going to trade down into this level and find support, right? I'm expecting it to trade to it and through it, right? And that's the difference in knowing narrative and trading patterns, right? I'm not trading fair value gaps and order blocks. I'm trading narrative that's in line with the higher time frame and institutional order flow. So I'm looking for it to trade to it and through it, right? So we got that last week. And again, further animation on the downside, we have these 3 down close candles and this inefficiency, and that's going to be the draw for Nasdaq on the monthly time frame. So that still does give about 700, about 1,000 handles on the downside. Gave you guys 1,000 handle range last week. Like I said, provide you guys the winning lottery numbers on the downside. So again, going to be continuing looking for lower prices, but again, you have to weigh that out with the market structure and the institutional order flow in the intraday as well. So again, one of the things that like I teach in my private group whenever I'm coaching is that we don't just look to go into the lower time frames and, oh, we're bearish, let's just go short at Monday's open, right? There has to be things that set up, which would be a run on buy stops, right? A trading into a premium inefficiency, right? You have to have certain things set up for the market to be high probability in your favor. So monthly chart, again, looking for lower prices, and those remain the downside objectives. So weekly chart, again, large range expansion, indicating to you guys that Nasdaq would look to catch up to Dow, and it did so in stunning fashion last week, trading down into the opening price of the bullish order block on the weekly chart. So nice delivery last week into the sell side and down into the bullish order block. So what this dotted line is here is it's this candle's range divided in half and extended through. So that's mean threshold of the bullish order block. So going to be looking for lower prices this week. Again, but we do have to monitor how we trade inside this key level, right? Because I'm not bullish, I'm not going to look for the bullish order block to lend support, but it was a nice target again on the downside for last week. But now that we hit this level, I'm going to want to see how we trade at the opening price. If we start to get steam down through that, we have the mean threshold. And if we accelerate through that, we have the sell side liquidity here, which is what I am favoring. So I am looking for lower prices into the sell side here. Yeah, then from high to low, 1,200 point range, man. Massive, massive moves in the Nasdaq. All right, so daily inversion, fair value gap here, market traded up into that. We used that last week on Monday, hit that level. Up close candle acting as resistance, market breaks down. Daily inversion, fair value gap here, trading up into that, using it as resistance. Again, I prefer to see the market trade up into that daily fair value gap and then run lower. But again, because it left that open, that's a signature that's indicating that it's even more, or not more weak, that it's even weaker than I was anticipating, right? So once we failed to trade into that daily fair value gap, that tells me what? We're exceedingly bearish, right? So these large range expansions to the downside into the liquidity pools that we were looking for weren't a surprise once you know how to read the institutional order flow, right? Because that now is classified as a breakaway gap and we're expanding lower, right? And that means the market's exceedingly bearish. So zooming out, we have this down close candle here on the daily chart. We'll want to monitor that. If we're able to get down through it, trade to it and through it, then we have the sell side here, this daily inefficiency, and then through that we have the sell side here. So those are my downside targets going into this week. Again, just because I give you all these targets on the downside from when we were up here, I gave you those targets here, 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 and this inefficiency last week. Again, just because I'm giving you all those targets, don't get fooled into thinking like it's going to be like last week, that every single target I share is going to get run into. It's a matter of weighing those things out. So the reason I give multiple targets is because what we did Monday, that was reasonable for really the first 4 days of the week. Like the weekly range was almost delivered on Monday based off what I was looking for in terms of a draw liquidity and my targets. But again, understanding that we're in a seasonal tendency for the market to move, again, world events, that all influences those factors as well. But again, it's understanding how to pivot and how to be flexible with the analysis. So the reason, again, I give the several targets is that need for flexibility, because it may not reach every single target. But if it reaches two or one or two of them, there's still money to be made in that without having every target delivered, right? So I don't want you to weigh the value of the market analysis in terms of the calls, right? In terms of all the targets being hit. Because what really matters is what's the bias? It was bearish. Does it give you a range expansion in that direction? Yes, it does. There's money to be made there. You don't need to get the range high to the range low. You just need setups that make sense in line with the higher time frame bias. And when those factors come together, that's going to make your trading very straightforward. So looking on the downside, we have this daily bullish order block. Again, down through that, we have those discount levels that all could be targets. All right, and then going to leave you guys off here on the 4-hour chart. So 4-hour chart here for Nasdaq, market retrace, rebalances, an efficiency, and we broke down. So now we have a premium fair value gap here. Going to look for us to trade up into that fair value gap and then look to break down and run for the sell side here and here on the 4-hour. So hourly chart, as long as you remain below that 4-hour fair value gap, I'm bearish into the sell side. If we get above the 4-hour fair value gap, it may be retracing deeper, and then we'll have to look at these relatively equal highs here. And then if we displace through that, we have this inefficiency here above market price. And that's what I'd be looking for on the upside if we get above the 4-hour fair value gap. However, because we're bearish, again, I'm going to continue looking for lower prices as a result. So share the targets, the expectations, even shared with you guys how to know if the market's going to retrace, because again, markets don't go straight down, right? They go down, they retrace, and then they continue expanding, right? So I also shared how to know when the market's likely to retrace as well, because those are things you're also going to have to factor into your analysis. So with that, guys, hope this one was insightful. That's everything I had in terms of my analysis. I'll go ahead and again take some of your guys' questions before I get going here to get ready for the week. Cycloss, hey guys, hi Dylan, trust you're doing well. Sorry I'm late to the party. No worries, Cycloss, glad to have you join us, brother. Give the live stream a like, much appreciated, thank you. Sandman, hey Dylan, great analysis as usual. Thank you very much, sir. Thank you very much. AP, hello Dylan, great analysis. Thank you, sir. Does NQ versus the contract make a difference when charging? Absolutely, yeah. So let me share some insight. So let's say Nasdaq continues to accelerate to the downside, right? One of the reasons that you have an advantage using the actual contract over the continuous is that you see like this gap here, and this is just one example. There's numerous you can use. Like this example, like this gap here, that is a volume imbalance or a liquidity void in this case where there's no trading. On the continuous contract, all this is going to be smooth price action, reflecting the previous month's contract. However, the algorithm will refer to these inefficiencies in its price delivery. So by having these key levels, and on the daily chart, I don't think there's much. Well, yeah, you can use that, right? So let's say on the daily chart, you're using this contract and we get all the way down here, which is absolutely possible. We have all these inefficiencies here that would be smoothed out on the continuous contract. You wouldn't be able to see these data points. But because on the official contract, you're able to see that, again, that's going to give you an advantage, because if we go over to the continuous, you see there's no inefficiency. And these are like these inefficiencies here that you see on the YM, right? Those are real targets that the algorithm will look to reprice to. And then again, if you're looking at the continuous, there is no inefficiency here. So again, it just gives you a bit more of an advantage in terms of targets and key inefficiencies that the algorithm will absolutely refer to. So that's why I use the front month contract. You can use the continuous for longer term analysis, but outside of like monthly chart and higher, I'm not using the continuous contract. Brown Stratkin, can you do a quick top-down analysis on YM? Yeah, so YM's interesting. YM's already reached its external range liquidity from this range low to high. So based off what I'm seeing now, I'm neutral on Dow. We called a massive run from the breaker to the fair value gap down into this low. So that's a 2,000 point run on the Dow that we just nailed. So whenever I have targets reached, again, that puts me in a place of having to be patient because these 2,000 huge, 2,000 point huge range price runs, those don't happen every single day, right? So once we have a big one that occurs and reaches the levels, you tend to have to be patient to see what the market's going to do from there. Right? So because I'm bearish, I don't want to give you higher targets, but also because we've reached considerable discount levels, it would be reasonable to see the market retrace back into the range, right? So because that underlying uncertainty, for me right now, Dow is more 50-50. And again, that's why I'm primarily going to be focused on the Nasdaq and the E-mini S&P. Obviously using Dow for confirmation, but nothing more than that. So Strat King, hopefully that clears that up for you. Richard, great stuff. Thanks for all you do. Much appreciated. Much appreciated. Julian, do you think big range last week means small range next week? Well, traditionally, one would expect that, right? But just look at the daily candles. Right? After a large range Monday, we did get a small range Tuesday. But then Wednesday, Thursday, and Friday, we had all large range days. Why is that? Understanding the global climate right now is the justification for why market makers are going to open up the ranges, right? So what would be considered normal would be a small range. But when there's volatility in the market, it doesn't always apply to those same exact principles. Like it's rigid in the sense that, okay, we had a large range, it has to be a small range. You also have to take into account, what's the current climate? What's the current market structure? What's going on in terms of geopolitical events, targets, and all those things come together to give you more clarity as to what you should expect. So it's not as black and white in terms of it has to be a small range. Really, with what we have going on right now, all I can say is be ready for anything. Cyclops, and please don't what you're saying on gold and GJ. Yeah, let's take a look at. I have not looked at gold. Man, gold is bullish until proven otherwise. Yeah, gold's at all-time highs. So if you want to learn more about all-time highs and trading markets at all-time highs, you can look at the pre-market videos that I did for you guys earlier in the year when indices are at all-time highs. And that's keep trusting buy models until they fail, right? So with what we have right now, we have all-time high protocols on gold, and you just keep looking for higher prices. And again, in light of everything that's going on in the world right now, there's a real fundamental factor why gold is going higher as well, right? Banks are scrambling to get their money into gold. From what I'm seeing, the ship's sinking on the financial level, and all the rats are looking to avoid drowning. So I'm seeing a lot of the banks, institutions, they're piling a lot of money into gold to get out of dollars and accumulate real assets, right? With what we have going on with inflation, the Fed printing money, the dollar, being as good as toilet paper almost with regard to inflation, all those factors breed uncertainty, right? So if we know these things, imagine these people with millions and billions of dollars, right? They're probably relatively sharp as well. I would go out on a limb and say. So with that, they're absolutely hedging themselves and positioning themselves appropriately. So that's the fundamental factors as to why I'm seeing higher prices on gold. Typically, I was getting asked, well, dollars higher, shouldn't that weigh on gold? Again, classically, yes, but in wartime environment with what's going on, that changes things substantially. So looking for higher prices on gold. Gold's bullish again until proven otherwise based off all those fundamental factors. So a lot of money going into the gold market based off, again, just the overall uncertainty and investors looking to put their money into what would be considered a safe asset, right? Because gold has been money as long as time. So, and then GJ. British pound, yen. Oh man, I got nothing to say about this market, brother. Equal lows, equal highs. Your guess is as good as mine. What you can look at to determine which direction it's likely to break out, you can look at the interest rate differentials between the pound and the yen. And then if the interest rate differential suggests it should trade higher or lower, that's how I'd go about seeing which direction it's likely going to leave. But this market structure here gives me absolutely nothing. This is market structure that I would consider gambling because it's not one-sided. Once we leave the range, yes, if you like the trade consolidation market profile, there is a science behind it, what it is doing in consolidation, so it is tradable, but not a market I'm willing to call because I don't see targets that are one-sided, and I wouldn't want to just talk out my ass here. So nothing on GJ, but hopefully gave you some insight on how you can move forward and use fundamentals to frame that. AP, thank you, sir. Absolutely. Strat King, Dylan, how do the heavy earnings now starting to affect how you expect price to deliver? So there's always heightened volatility around earnings season. So that's the only adjustment in my expectation is around earnings. There's typically higher volatility in indices for those weeks. The other key point is knowing when those earnings reports are happening, because many times before large companies' earnings reports, they will hold the market in a consolidation for the PM session. And a few times when I was first developing, I would get caught off guard by that. I would trade the PM session as if, it was just going to be standard delivery for the afternoon. And then they ended up just holding it in a nasty consolidation. And then I had no idea what was going on until I was like, why are they holding this thing? And then I realized that they were holding it to reprice it on the earnings report right after the close, right? So you can absolutely trade these earnings reports because it does bring volatility into the marketplace, which is, again, what we need. But I just say that to say that you do need to be mindful of when those events are coming out because, again, you don't want to be retail Rick, have no idea the earnings report's coming out and get caught and chopped for an hour and spend all your mental capital. So I would definitely recommend being mindful of it. And those are the only two things I would say on that front with the earnings reports. And they also do use those reports to deliver into targets as well. Cyclops, thank you, Dylan. Some thoughts too? Same thoughts too? Absolutely. Amy Moore, what are your thoughts on YM and crude oil? Yep, so I shared Dow already. Let me take a look at crude. And crude right now is a bit wonky as well with, again, with wartime events and everything that absolutely affects the oil markets. So expect a lot of volatility in the oil markets as well. So again, we've seen the crude oil has been on a tear higher, and so it's reasonable to see the market retrace. So it's pulling back down into the range. It can retrace as far as this down close candle. Then once we get down in that down close candle, I'll have to see how we trade there on crude oil. I haven't yet abandoned the bullish bias on crude outside of the retracement into the fair value gap. As long as we remain above this weekly bullish order block, I'll be looking for higher prices on crude oil. And then we have these relatively equal highs here and here. That would serve as the draw on liquidity. So the daily chart, this is where the uncertainty comes into the analysis. We retraced, we tried to trade higher into this fair value gap, and we weren't able to sustain that delivery. And again, this is all a lot of manipulation because, again, what's going on in the wartime events. So seeing the market stand below these inefficiencies here, that's indicating it's bearish on the daily chart short term. We have equal lows here, equal lows here. There's a lot of sell side liquidity below that. A lot of people were wanting to see crude oil be taken higher. And where would their stop be? Below these lows. So if we remain below this daily fair value gap here, if we remain below that, we're looking for these equal lows here on crude. If we accelerate through those lows, we have this inefficiency and these equal lows down here. So that's what I'm looking at on crude oil if we stay below this daily fair value gap. If we get above it, then we're off to the races and we're going to continue trading higher on crude oil. Amy, so there's crude and Dow for you. Just liked, grateful. Thank you, Amy. Grateful to have such an amazing community here as you guys as well. So the gratitude goes both ways. Olawale, appreciate the session as always, Dylan. Quite insightful. Absolutely, Olawale. Glad there's value in it for you, brother. Denisha, thanks again, Dylan. Be safe in the charts this week. 18. Absolutely, Denisha. You have a marvelous week as well. All right, guys, 4:56. I'm going to get out of here. Please do hit the like button. Again, that helps me out greatly. And again, keeps me motivated to keep coming out here on Sunday and doing these sessions for you guys here on YouTube instead of on Zoom or in Discord. That'd be pretty boring. I do like coming out here and hanging out with the YouTube community. So again, continue to hook a brother up. That does, again, keep me motivated to come out here again and keep giving this value to you guys. So, all right, guys, ladies and gentlemen, take care. Good luck and good trading. Have a great week, guys. See you, Tyler. Frank, take care. Rich, absolutely, brother. Have a great one. See you, Julian. Bye, guys.